Welcome to the Hurst Trading Room. My name is David Hickson and this is a video update for the 23rd of March 2015. As always, before we take a look at the markets, please make sure that you have read and understood these disclaimers. Just a reminder to subscribe to our podcast channel on either iTunes or YouTube to make sure that you receive alerts as soon as I publish a new video. Let's take a look first of all at the S&P 500. Now, when I recorded the previous video about 10 days ago, I mentioned that there were two possibilities, and these are two possibilities that I have been discussing for the past several weeks. The one possibility was that price was coming down into a 20-week cycle trough, and that's the possibility that you see displayed on this chart over here. As you can see, price came down into that 20-week cycle trough. I explained in the previous video how I had entered into a short trade to profit from that move, and mentioned that of course the next trade would be a long trade as price bounced out of that 20-week cycle trough, which is exactly what it did, as you can see. Now, there was another possibility that I was considering 10 days ago. In fact, I've been considering it over the past several weeks. If you go back, you will see full descriptions of the other possibility. Let's take a quick look at that. And here it is over here. And that possibility is that the 20-week cycle trough occurred early at the beginning of February. Now, in my opinion, this is still a valid possibility. I think this analysis has not been ruled out, and a few weeks ago I was thinking that this was the most likely analysis. Now I must admit I don't think it's the most likely analysis. I think that it is still possible, but I think that the other analysis with the 20-week cycle trough forming in the second week of March is probably the correct analysis. But this is still a possible analysis, and according to this analysis, of course, as you can see, price bounced out of that 20-week cycle trough with a good strong move at the beginning of February, and the move down into the trough in the second week of March was a move down into the 40-day cycle trough, as you can see. And in the previous video, please take a look at it if you haven't yet viewed it. I discussed how it didn't make a huge amount of difference in terms of my trading decisions whether price was heading down into a 40-day cycle trough or a 20-week cycle trough. And if that surprises you, let me just repeat a really important point about that. It's one of the reasons why I love using Hurst cyclic principles to analyze the markets and to trade the markets. Because even when there is some analysis uncertainty, you can nevertheless make correct and profitable trading decisions. It's a very, very important point, and it's one of the reasons why I love working with Hurst cycles. And in this particular instance, of course, price was moving down into the 40-day cycle trough, and according to the FLD trading strategy, we were in a short D category trade at that point. The alternative was that price was moving down into the 20-week cycle trough, in which case we were in a short F category trade. Hurst Signal subscribers were in a short F category trade in the S&P 500, and it turned out to be a very profitable short trade. Whether we called it a D category trade or an F category trade doesn't really make a huge amount of difference. It does make some difference, interestingly, because of the different character of those trades. A D category trade is expected to achieve its target and then bounce up from that point. An F category trade is expected to be a more profitable trade. But those are subtleties. The bottom line is that we were trading in the right direction and making profitable trades. And of course, the next trade that I spoke about in my previous video was a long trade, and I mentioned that it would either have been an E category trade, which of course would have been because of this particular analysis with the 40-day cycle trough in the second week of March, or at least the E category trade is the trade that we would have taken as price bounced out of the 40-day cycle trough. Or, of course, we would have been entering into an A category trade if price was bouncing out of the 20-week cycle trough. Now, what happened to G and H in between there? Now, that's an interesting thing. G category trades are long trades that we don't take, and they happen as price comes up towards the 20-day FLD and then comes down again. And there's always a slightly anxious moment as price comes up to the FLD and you're trading using the FLD trading strategy. You have to ask yourself, is this the G category interaction when price comes up to the 20-day FLD, in which case I don't want to take the trade, or is this the A category trade? And you will notice on the Hurst signal system, if the previous interaction was an F category trade, the Hurst signal system will advise you that the next trade is expected to be a G category trade, which you should not take. However, if the cycle has been running long enough for it to be considered to be an A category trade, then the Hurst signal system will say you should consider the possibility that an A category trade is coming next, in which case, of course, you should enter into a long trade. And that's exactly what the Hurst signal system was doing at this point, because the Hurst signal system had the other analysis. Let me quickly shift back to that chart. And where are we here? So that's the analysis that the Hurst signal system was using, because of course Hurst signals doesn't just push out the analysis that I think is the best analysis. We have a small team who monitor the analyses and do as little interference in the analysis as possible. And so there was the A category long trade as price broke up above the FLD. How did I handle that personally? I had two possibilities in my mind. Either it was a 40-day cycle trough or a 20-week cycle trough. And if it was a 20-week cycle trough, then that might have been a G category trade instead of an A category trade. How do I handle those details, if you like? Let me explain it to you, because I hope there'll be a lesson to be learnt there. First of all, when I have two analyses and both of them are recommending a long trade, as was the case here, then I will, let me just zoom in here, I will zoom in and take a look at that FLD, and I will choose the FLD that is the safest FLD. In other words, the FLD that is slightly further away from the market. So take a look at this FLD, you can see it here, and on Monday of last week, price came up to the FLD, just touched it, as you can see. Really accurately touched it, and then price straddled the FLD for the next day, and then on the Wednesday came down right down to the FLD. That's something that you often see. The FLD acts like a magnet to price. It draws price to it. So that was not a surprising thing to see. And then, of course, price broke upwards. Now, did I enter at the level of that FLD on the Monday? No, and I'll tell you why. Because the other analysis that I was considering, which was this analysis over here, let me zoom into the same level of detail, had a slightly different level for the FLD. Not very different, but slightly different because of the different analysis. And so I was watching both of these analyses, and when I'm making trading decisions and there are two possible analyses, I set my entries not at the FLD level that is closest to price, because then if that turns out to be the wrong analysis, then I've been stopped into the wrong trade. So I choose the FLD level that is slightly further from price. So of course the FLD level that I was trading was this FLD level, according to this analysis, and as you can see on the Monday, price didn't quite get up to that FLD. You can see that gap there. So the Monday price didn't reach the FLD, but on the other analysis it did. So that was a very interesting moment. On the next day, price remained below the FLD. It was clearly encountering a little bit of resistance. Now, I was expecting a bounce either out of the 40-day cycle trough or out of a 20-week cycle trough. Or there was the possibility that this was the G category interaction as price came back to the FLD. How do you handle that? Well, in the back of my mind, I thought this might be a G category interaction, but I really think it's probably an A or an E. Therefore, I want to go long, but I must be a little bit cautious. So what I did was not set the entry at the level of the FLD as the FLD carried on coming down. And in fact, let me zoom in even closer on this price action so that we can really speak in detail about it. You can see that on the Monday, price didn't quite touch the FLD. But it was definitely a wake-up moment. It was, okay, price is potentially bouncing out of a 20-week cycle trough. Let's pay attention here. The next day, price remained below the FLD. On the other analysis, as I showed you a moment ago, of course, that price was straddling the FLD. So clearly, price was about to or in the process of interacting with the FLD. I did not set my entry at the level of the FLD because that would have been a little bit foolish. In the back of my mind, I thought this might have been a G category interaction. But there's an obvious level at which I could set my entry, which is exactly what I did, which was the level of the high of Monday. Okay, so there's the high of Monday. It was somewhere over about 2073 or something. I gave it a little bit of room, 2075, round about that area. And so on the Tuesday, price remained below that. And if price continued down, as it looked as if it was going to do early on the day on Wednesday, then of course that would have probably turned out to have been the G category interaction. But as soon as price came up above the Monday high, that was clearly the A category interaction, and therefore I was into my long trade. Or of course it could have been the E category interaction. So what do we do next? Well, let's just zoom out a little bit here. And what's going to happen next? If this analysis turns out to be the correct one with the 20-week cycle trough over here in roughly the middle of March, then of course this is the A category interaction as price crossed the FLD over there. Next we expect a B category interaction as price comes down to the 20-day cycle trough, which is expected around about the end of March. So I do not trade short for a B category interaction because I expect price to come down to the FLD and to track along it. So that is my most likely scenario as far as I'm concerned. But certainly as price comes down towards that FLD, I will watch it very carefully and I will consider entering into a short trade. Why? Because the other analysis, and let's go back and take a look at that, is still a possibility. And here is that analysis. And if this turns out to be the true analysis, then of course that was the D category interaction here. This was the E category interaction, the long trade that we went into. And you can see a very nice M shape in the process of forming here. It might have reached its peak on Friday. It might not yet have reached its peak. But the next interaction, the important thing is that this is going to be an F category interaction. So here we still have some analysis uncertainty. I'm still not convinced about which analysis is correct. Personally, I must say I think it is more likely that the other analysis is correct now, which means that I am going to give the market a little bit of room as it comes back down towards this FLD. I'm not going to jump into a short trade. I expect to see price coming down to the FLD and then probably tracking along it and then bouncing up for another little bit of a run upwards. But if price comes down to the FLD and then plunges straight down through that FLD and moves strongly downwards, then I will say, okay, this is the correct analysis and I want to be in that short trade. If I miss the opportunity, well, then I've missed it. I don't want to jump into something which I'm not certain about. So, you know, if I miss it, too bad. But if price does give me a good opportunity, such as coming down to the FLD, perhaps just touching it, providing me with a low level at which I can set my entry, then I will do that for the short category F trade. As a matter of interest, let's take a quick lightning tour around some of the other markets. This is the S&P 500. But let's take a look at some of the other markets because it's very useful to compare those markets. Another US market, the Dow. Here you can see we're getting some very good clear shapes. This looks very good for the 20-week cycle trough here in the middle of March. Of course, there is the possibility that this was the 20-week cycle trough at the beginning of February. But you know, I've got some good shapes going here. Here's the 80-day cycle, and then here's the M shape of the next 80-day cycle. It's a slightly inverted M shape, with the center point of the M shape dropping slightly below the start of it, but really only a few ticks there at the beginning of February, a few points maybe. So I'm not too bothered about that. Those are good, clean cycle shapes. They're certainly not similar or identical cycle shapes, but they often aren't. You should never expect cycles to be perfect in the markets. So that looks good to me, with the 20-week cycle trough forming there in March. But the European markets show us an even clearer picture, I think you will see, which tends to support the idea that the 20-week cycle trough occurred in the middle of March. Of course, the 20-week cycle trough might have occurred in European markets in the middle of March and in the US markets at the beginning of February. That is by no means impossible. But here you can see the good, clear cycle shapes. Here is the first M shape for the 80-day cycle in the FTSE. Sorry, this is the FTSE 100 I'm looking at here. Here is the next M shape, although there's a bit of a question mark around where that 40-day cycle trough should be. But bear in mind there was a lot of volatility surrounding the Swiss National Bank unpegging of the Swiss franc against the euro, which happened in the middle of January, and that's very likely well, it is this period over here, and it's very likely what caused that sort of slightly unusual price movement round about there. So in fact, Sentient Trader has placed the 40-day cycle trough over here towards the end of January, which is more likely to be the correct placement of it, in my opinion. But you can see here that the question of whether the 20-week cycle trough occurred in the second week of March or whether it occurred at the beginning of February is not really a very big question. It's so much more obviously happening in the middle of March there than at the beginning of February that the FTSE certainly seems to indicate that the 20-week cycle trough occurred in the second week of March. Let's see what else we have here. The DAX. Now the DAX is a really interesting analysis, because the DAX has just been steaming upwards with tremendous vigor, and it makes it very difficult to position the 20-week cycle trough. As you can see, I've pinned it in this analysis, but it's resulted in really staggered and broken up nests of lows. There's still not a very clear analysis in the DAX. So the DAX is an interesting analysis in that it doesn't really provide us with anything very clear. The most likely position for the 20-week cycle trough still remains the 9th of February. So it would seem to indicate that the market was bouncing out of a trough there. But the DAX has been really distorted by fundamental interaction. Fundamental interaction is when news or politics or events in the world cause markets to move fairly strongly in a way that isn't very cyclical, perhaps is the correct word to use. And Hurst called that fundamental interaction, because of course news events do affect markets, and they aren't the prime motivator. Most Hurstonians or Hurst analysts would tell you cycles are the underlying cause behind movements in the stock markets, but of course news events do cause a distortion of price movement. And there's been a lot of politics in Europe recently with the Greek elections, and the German market has been extraordinarily bullish, as you can see, and it has made a cycle analysis very difficult. What's the first sign of a market that has a very difficult cyclic analysis? Well, the fact that you don't get any clear troughs. And in fact, let me just clear that and show you exactly what I mean, because from the beginning of this year, pretty much, we had a good, nice, clear trough in the first week of January. But after that, our troughs that occurred in this market are really tiny little moves with only a day or two of downward movement. You can see all those little tiny troughs, not any really clear, obvious troughs. Now, when that happens, as a cyclic analyst, the most sensible thing to do, in my opinion, is to take a bit of a step back, because we don't really know what's going on. You know, the 20-week cycle trough probably occurred somewhere. Oops, it probably occurred somewhere in this period. My pen is doing strange things. It probably occurred somewhere in this period. Perhaps the 20-week cycle trough is only in the process of forming right now. But certainly, I'm staying clear of the DAX for now. There was a very profitable trade that was made on the basis of, I think it was this FLD interaction here. That turned out to be a fantastically profitable trade. But since then, it's been very difficult to trade the DAX. What else have we got? Just quickly, Euro stocks. That's an interesting. What's going on with this chart? There we go. That's an interesting conglomeration of European stock markets, and here you can see as well, I haven't pinned these charts or anything, I haven't influenced this analysis. Sentient Trader has all on its own decided that the 20-week cycle trough occurred on the 10th of March, I think it was. So again, this analysis supports the idea that the 20-week cycle trough occurred in the second week of March, and the possibility of the 20-week cycle trough occurring at the beginning of February. There's the 10th of February, there's the at least the 2nd of February, and there's the 9th of February. Those really don't look like very good troughs for the 20-week cycle trough. The best trough for the 20-week cycle trough certainly seems to be this one here on the 10th of March. So the Euro Stoxx index seems to concur with the idea of a 20-week cycle trough occurring in the second week of March. And here's the CAC 40. CAC 40 has also been a little difficult to analyze. Similar to the DAX, the French market has also been very bullish, but it did come down very strongly, really just over the weekend, 2 weekends ago, and Monday and Tuesday came down to form what was most probably, in my opinion, the 20-week cycle trough. So those are the stock markets. Let's take a quick look at the euro. Now, the euro, as you know, I have been expecting a very long cycle trough to form, and the market came down last week, or the Friday before last, and it formed a trough at a low price. What was that level? Oops, I don't really want to be pinning troughs at this point. What was the low price there? It was 104.6, or euro and 4 cents. At least $1.04 for a euro. And as you can see, there's been a little bit of a bounce up since then. Now, I'm not jumping into long trades, as I've mentioned several times. It's very important when the market comes down into a really long cycle trough such as this one, and you can see the nest of lows, which has not yet been confirmed by Sentient Trader. Here's this nest of lows. It's saying this long cycle trough is due, but it's not yet confirmed by any means, but I've certainly been watching the market. And last week, price bounced up very strongly. And do you notice where it bounced up to? And I know I keep going on about the FLD, but the FLD is such an important line for the market. You can see price came right up to that FLD. It really just about touched it. And then it came down again, and of course today it has almost by default sort of climbed up above the FLD, which is not a very good clean cross of the FLD, I must point out. But I'm watching the euro carefully, and again, what I would expect to see is, if the euro is bouncing out of a very long cycle trough, then I would expect to see bullish cycle shapes forming. Now, we've only had how many days since then? If we count the bars, they've been 10 days. So we would be expecting a 10-day cycle trough to form around about now. Perhaps the 10-day cycle trough formed at the low on Thursday of last week. That's not impossible. Slightly early, perhaps, for a 10-day cycle trough. But so far, those 10 days are looking fairly bullish. It's definitely a bullish 10-day cycle. A bullish 10-day cycle, in my opinion, is not enough when you're considering a bounce out of a really long cycle trough. Let's take a look at a different analysis. I think we've got an analysis here. Yes, here's an analysis that I've been showing you in recent weeks. And as you can see, Sentient Trader has decided that that 54-month cycle trough has occurred. Well, I would take that with a pinch of salt. We are expecting that a very long cycle trough to form, but certainly it might not have formed yet. You can see here price came up to the FLD according to this analysis, went up a bit above it on Wednesday, tracked along the FLD on Thursday and Friday, and has come up above it today, but again not a very meaningful cross yet. So I'm going to be watching the euro, looking out for those bullish cycle shapes, which we must see forming before we can say yes, that 54-month cycle trough has occurred. Let me just point something out to you and play a little bit of devil's advocate and mention something fairly interesting. Here we go. Let's get the semicircles on. And this was pointed out to me, I think in a comment on the Academy or perhaps in an email, and somebody mentioned that or asked the question, is it possible that the 54-month cycle trough did in fact occur, or has already occurred, I should say. Let me turn that pen off and let me start measuring some bars. 54 months, you can see, was that's 55 months. That trough at the end of January was 55 months. This fairly prominent trough in October of last year was 52 months. And I've been asked, is it possible that the 54-month cycle trough actually did occur over here or over here, and that what we have seen since then has been the start of the next 54-month cycle trough, and because the underlying trend, the longer cycles, are pushing down so strongly, the bounce out of the 54-month cycle trough turned out to be a terribly disappointing affair of only a few weeks, as you can see from either of those. The answer, of course, is yes, it's possible, but in my opinion, very unlikely. For a 54-month cycle trough, I do think it's unlikely that we saw such a miserable bounce. So it's an interesting question. It's an interesting thing to consider, but I am certainly looking for the euro still to turn around. Now, I thought I had a request actually to talk about gold. So let's quickly take a look at gold. I don't want to make this video too long. I'm not going to spend too much time speaking about it. But here is a chart of gold going back to 2004, and here, of course, is the very strong bull run right up to the peak in I think it was September of 2011 for gold, right up at round about the 1900 level, as you can see. At which point, of course, price formed a very major peak. It was a peak of, in my opinion, at least 4.5 years, 54 months. So a very prominent peak. It might have been a peak of 9 years. We don't have enough data to even address that question in this particular analysis, but certainly a very, very prominent peak. In fact, interestingly, in September of 2011, we had somebody working with us at Sentient Trader. He still works with us, and he'd been enjoying analyzing using Hurst cycles, because of course all the people that work with us use the software as well. And he was saying, "Oh, gold has been so fantastic. I think I should put some money into gold. Let me take a look at it in analysis," and came back. It was before the peak formed. I think it must have been about August of 2011. I said, I don't know why it is, but all my analyses keep saying there's a big peak, but I really want to buy gold. And of course I said, whatever you do, don't buy gold now. I think it would be the worst possible time. And it did indeed turn out to be the worst possible time. But what's happening with gold now? Well, let's turn off these semicircles and zoom in a little bit here. As you can see, there have been two, let me put the semicircles back on again. There have been two 18-month cycles since the big peak in September of 2011. And we can see them here. The first 18-month cycle formed a peak in early October 2012, and then we could discuss and debate at length when the next 18-month cycle peak was, but I think the most likely point was this point over here, which was in March of 2014. So we are now in the third 18-month cycle. What does that mean? Well, let's just zoom out a little bit again and discuss what that means. If we're in the third 18-month cycle of a 54-month cycle, the third 18-month cycle, of course, expects is expected to bring price back up to the next 54-month cycle peak. Okay, over there I get so used to speaking about troughs that I have to be careful to make sure when I'm speaking about gold that I speak about peaks. So so this 18-month cycle is expected to end up as a very bullish cycle, really, because we are expecting price to come back up and form a good 54-month cycle peak. It almost certainly won't be back up at the levels of 1900. That circle there is not meant to indicate a level at which I expect gold to rise. It was really just pointing out the semicircle here for the 54-month cycle. So here is the 18-month cycle in price, and it is expected to bring price up for a 54-month cycle peak. So generally speaking, I'm looking for a long move in gold, and if we look at a little more detail, perhaps we can get a better idea for the timing. The long move is the move that I'm expecting will bring price up to a 54-month or 4.5-year cycle peak. And so that's expected to be quite a good move. When is that peak expected to form? Well, you can see from this nest of lows, it's expected to form sometime later this year. That nest of lows is centered on round about September, October, November this year. However, the 54-month cycle, circle and whiskers, you can see is quite a lot later. So it's quite possible that's in about March of 2016. So I'm looking for a bull move up into the end of this year or early next year in gold. Has that bull move started yet? No, is the simple answer. I don't believe that it necessarily has, but it might have. So let's take a look and consider that question carefully. Here you can see the action since March of 2014, when the most recent 18-month cycle peak occurred, in my opinion. And there was the first 20-week cycle, and here was the 40-week cycle. So there's a good W shape. Of course, we get W shapes when we consider an inverted analysis. I won't spend time speaking in this video about why this is an inverted analysis. That's a very long discussion, but I will certainly discuss it at some point when there's a little more time. So there was a 40-week cycle peak, which in my opinion occurred, I think it was towards the end of January this year, 2015. Price has fallen down from that 40-week cycle peak, and it's expected to make another W shape, of course. Now, just as a very rough guideline, I tend to draw fairly symmetrical W shapes or M shapes, and that's a really rough guideline. You know, by no means is that an expected path for price, but we expect to see a W shape. So there is a trough which is expected round about now. So it's possible that trough has formed. And in a moment, I'm going to show you another chart, another view of gold, and we can discuss whether that trough has indeed formed or not yet. So price is expected to rise up to a 20-week cycle peak, which you can see I've drawn very roughly round about here, late summer or late July, and then we're looking at another trough coming down here early September, very roughly speaking, and then of course the big peak at the end of the year. So that's the sort of expected longer term picture. And in fact, let me show you, we have gold now on Hurst signals. So let me show you this. Here we go. This is the gold using peaks as an analysis. As you can see, it's currently in an F category long trade because prices just interacted with the 20-day FLD. If you're not used to the concept of inverting an analysis, I know this might be terribly confusing, so let me not dwell on it, but what this analysis is telling us is that the move up has started towards a long-term peak. Now let's consider, let me turn that pen off, let's consider another analysis on gold, And I always do this, even though I believe gold should be analyzed with synchronized peaks. I also always do an analysis with synchronized troughs, because that is what Hurst did. And so, I think it's important to keep doing that, even though Sentient Trader has the ability to invert the analysis process. Here you can see these are the troughs, of course, that are plotted on the chart. So there was an 18-month cycle trough. There we go, right at the end of 2011, following the steep fall of the September 2011 peak. And there was another 18-month cycle trough in late June 2013, probably another 18-month cycle trough in October of last year. I'm not going to dwell too much on this analysis. It's the first time I've started speaking about gold. We'll revisit this analysis certainly over the next months to come. But here's a very interesting detail for the analysis. You can see this analysis looks really good. We have an 18-month cycle trough here in November of 2014. Now there's an interesting correlation with stock markets, which had what was probably an 18-month cycle trough, or at least a 40-week cycle trough in October of 2014. Are you seeing some commonality already between gold and stock markets? It's an interesting commonality, and again, something we could speak about for a long time, but I won't dwell on it here. And here is the 80-day cycle. There's the M shape for the 80-day cycle. The 80-day cycle trough, according to this analysis, formed in the first week of January 2015. And we have since then seen a much simpler up and down move for the next 80-day cycle. And as you can see, the 20-week cycle trough is expected to form here. Here is the nest of lows. So that a 20-week cycle trough was expected to form last week. And what happened last week? Price, gold, bounced out of a trough. Okay, sometimes Hurst analysis is a beautiful thing. This analysis was showing us that we should expect a 20-week cycle trough last week, and indeed a trough formed. Isn't that beautiful? So let's take a look at what Hurst signals were saying as a matter of interest. Here's the Hurst signals analysis for gold using synchronized troughs, and as you can see, there's that same 20-week cycle trough. It looks slightly skewed over to the left. In this particular analysis, there are probably some subtle differences in the analysis, but here is that good A category long interaction, resulting in a very good profitable trade. In fact, that A category trade might already be over if we turn on the 20-day FLD and just zoom in a little bit and have a look at it. You can see that the level of the price cross of the FLD was probably about over there. There is the low. So we have less than one grid line to the target. So the target, just roughly speaking, was quite possibly achieved on Friday of last week. I'd have to look at the details, or maybe we're just below that target. But that first move is very possibly complete. But it certainly looks very good for a bounce out of a 20-week cycle trough. So what am I saying about gold? I've looked at a trough analysis and a peak analysis. I think it is very likely that gold is now bouncing out of a 20-week cycle trough. It's not impossible that the 20-week cycle trough lies ahead of us, but very unlikely. So I think gold is climbing out of a 20-week cycle trough. It needs to head towards a 20-week cycle peak. And let's go back to the other analysis and plot the next few months, if you like. So we have bounced out of a 20-week cycle trough, I believe. We are going to hit an 80-day cycle peak somewhere in the middle of April, perhaps. And so we'll see a bit of a fall down there, and then we should see another climb up to a 20-week cycle peak sometime in late July. What is this trough over here? Let's go back to our trough analysis and talk about what that trough is. And let's just zoom out a little bit here and shift it over to the left so we can see what troughs we have lying ahead of us. And there we go. Turn the FLD off and So here's the 20-week cycle trough, almost certainly. We had an 80-day cycle peak, and then we had another trough, which is probably going to be a trough of the 80-day cycle, and that's going to be in June. Then we should see price rising up to a 20-week cycle peak, after which, of course, it's going to come down fairly strongly into this 40-week cycle trough in August. So that's going to be a 40-week cycle trough in perhaps late July, perhaps sometime in August. And then, of course, we are still expecting price to bounce up again to what will eventually be probably a 54-month cycle trough. So what does that mean? Should you be buying gold right now, today? No, don't rush out today. If you'd bought it last week, that would have been good, but I wouldn't rush out today. Of course, I use the FLD trading strategy, and so I trade interactions with the FLD, and that A category long trade is quite possibly over, but I will look at a good bullish 20-day cycle, at which point I will try and get in for a C category trade, or a bullish 40-day cycle, at which point I will get in for a long E category trade in gold. And we're going to have several trading opportunities over the next several months. But the bigger picture, if you like, is that I am expecting gold to rise to a peak towards the end of this year. Thank you very much for joining me in the Hurst Trading Room this week. I look forward to seeing you next time and wish you, as always, profitable trading.